Hello, this is another video with my old colleague Will, where we talk about some of the important points of trading. This time around, we're going to talk about risk management, position sizing, all of that sort of stuff. It's been a really tough couple of months for most retail traders. People are losing more often than even before because of the market volatility. I think because of the swings we've seen, people who've been long or short, just in the volatility, have been getting taken out. So I think it's quite timely to do this video now to give some extra things to think about. Trading is not about where do you buy, where do you sell. Obviously that's important, but there's so much more to it than that. I think that one of the frustrating things of trading is you can still be right on a market but still end up losing money, and this is where position sizing, volatility, all of that comes into it. So let's get into it. Hello and welcome back to another video with me, David Jones, and my old colleague Will Hardy. Will's worked in markets for longer than I have, starting off on the life floor, the London Futures Exchange, back in the 90s, and then working for various brokers over the years. In this latest series, we're going to have a look at the foundations of successful trading. I think when we first come into trading, we all think it's about entry. Where do I buy? Where do I sell? That's 90% of trading. But in reality, it's probably not even half of trading. So we're going to look at different aspects of trading that both new and perhaps relatively experienced but not consistently profitable traders might find useful. This time around, we're starting off with what we both think is one of the most important topics, and that is the idea of risk management. There's more to risk management than just saying I'm going to buy gold here and I'm going to put a stop loss here. We're going to explore it a bit more over the course of probably more than one video. So Will, let's get into it. When we talk about risk management, let's start right from the basics. If I'm relatively new to trading, what do I need to think about first of all?
Great. So as you mentioned, stop losses are always going to be key, but there's more to it than that. I think everyone knows now, that stop losses are the tool that we use to control risk and markets moving against us. I think number one, the most important aspect of trading is preserving your capital. And so the worst case scenario for anyone, and as you said, whether they're coming into this new or been trading for a while, is to blow up and to regularly blow up your account. So,
and what do we mean by blow up? What are we talking about there?
Lose all your money.
I thought that's what it was.
I don't think there's any other definition, but it obviously, first and foremost, and actually let's take a step back. Most importantly, any money that you're putting in a trading account, you must be able to afford to lose. Okay, so only use risk capital. Don't start getting loans out, borrowing money. It's all going to end in tears, isn't it? It's going to be a disaster. There's too much pressure when you're in that situation. So first and foremost, make sure that the money you put in your trading account is money that you can afford to lose. It's not going to affect your day-to-day life or your family's life. The next point then is preserving that capital. So we're going to trade, we're going to look for opportunity, but what we don't want to do is blow up within 2 or 3 trades, wipe the accounts out, and then we're starting again. So capital preservation is down to how much risk we apportion to every trade that we do.
Okay, so we need to think about this when we first start. If we're putting, let's say we're putting £1,000, $10,000, 100,000 euros, whatever it is, we think, right, that's my lump sum of money, that's my risk capital. How much am I willing to lose on any one trade? So if I buy the NASDAQ and I put a 500-point stop loss on it, if I get stopped out, it's really important to think about the financial hit to my account, isn't it? So if I've got a 500-point stop and I'm doing the equivalent of £1 a point and I've got a 1,500 quid account, I'm risking a third of my account on that one trading idea. Is that a correct approach, would you say?
Probably not. It's obviously a large chunk of the account size to be risking on a single trade.
I think it is a bit of a double-edged sword, the whole risk management thing, because the reality is, when you first start, and even when you've been doing it for a while, you should be really conservative.
Yeah.
And a lot of the old trading approaches, which I would still agree with, talk about any losing trade only costing you 1 to 3% of your account. But if you've got let's say a £500 account, a $500 account, then that's only $10, $15, £10, £15 risk per trade. So, and I think that's the frustration for people who are starting to trade, is they can, if they're being right, they're not making much when they're right. So there's always the temptation, I think, to risk more and more. And I don't think you can ever risk too little, but I think it is absolutely a double-edged sword, this, that people want to see gains. But just, I think it's just something to be really aware of. One of the big reasons why people lose isn't necessarily that they don't have a clue which way the market is going. They're just risking too much money, and after a run of losing trades, you know, maybe 5 losing trades, obviously if you're risking 20% of your account, if you have 5 losers on the run, you've wiped your account out. So do not underestimate this part of your trading journey, is thinking, I've got this much money, however this much is, how much am I willing to risk? And I would always say that smaller is better.
Agreed. You know, the most important thing, as you're saying, you know, is just don't blow up that account in a couple of trades. You know, it's really just not going to, you know, sort of be something then that's going to sort of bring you back to want to do it again. So this discipline is very important. Where you set that number, I think we might agree then, David, you know, that sort of 10% perhaps of your you know, risk capital per trade is the absolute maximum. That's maybe, you know, where I might go up to. You'll be a bit more conservative, but certainly no more than that. And again, particularly for new traders, you know, then I would agree, you know, keep risk to a minimum whilst you are trading with real money. Again, coming back to that emotional you know, side of trading, when you've got real money, even if you're risking small amounts, it makes you do very different things. It makes your relationship with your trades very different than if you were trading on a demo account.
Absolutely. And I think, I think I've mentioned this before. I think my recommendation would be to spend as little time as possible on a demo account. I think I can remember talking to somebody, it's going back a few years now, but this person had been trading on a demo account for 3 years. And they were brilliant on a demo account. But what is the point? You know, because as we both know, it's completely different when there's real money at risk. So I would say start trading if you want to learn how to trade, but absolutely start small. You know, if you've got £10,000 of risk capital, don't open an account with £10,000. Open an account with £500 or £1,000 if you're new to trading. But get off the demo trading thing and actually start trading with real money, no matter how small that is, because the emotions and the psychology is completely different when there's money on the line. So let's just pause there. You know, I've got my own story of being an overconfident and somewhat idiotic trader. You know, when I first started trading back in the 90s, perhaps like a lot of people, you know, I thought I knew everything about trading, such as the arrogance of being in your 20s. And I started trading with a £5,000 account. Back then, there was nowhere near the amount of brokers to trade with small account balances, all that sort of stuff. So I started trading futures. I had a £5,000 account, most of which was a bank loan / overdraft. Stupid mistake number one, but of course I knew everything. How could it go wrong? And I traded FTSE futures, the actual future on the FTSE 100, the UK stock market index. And the minimum tick size for a future, back then the FTSE, was £25 a point. So I was setting 50-point stop losses, which again were too tight. More of that in a second. So my risk, 50 times £25, was £1,250 every trade when I was doing one contract. My account was £5,000. So I was risking 25% of my account balance on every one trade, risking losing if I got stopped out. Absolutely ludicrous, but of course I knew it all, and I was about to turn my PC into an ATM that just printed money. Needless to say, you know what happened? I think within a year, I'd almost blown up most of the account, so closed it down and went away to lick my wounds. So it's really important. This stuff, I knew all this stuff back then, but I chose to ignore it because I thought, well, those rules apply to somebody else. They don't apply to me, you know. And I've really learned over the 30 years-ish since then how important this aspect of trading is. It's not just about where you click buy, where you click sell, what color your moving averages are. So it's really important. If you're new to trading or you're finding trading difficult and your account is swinging around, this whole position sizing thing is absolutely critical. A quick commercial. if you want to find out who I trade with and the broker I recommend, if you go to bit.ly/David Trade, I've traded with them for a few years. The big upside for me, you can trade really small. You know, we looked at some trading examples and we'll look at some more as we go through this video and other videos. You can trade at a level of risk that suits you. So you don't have to be like me 30 years ago, taking silly levels of risk. You can link it all into TradingView. The charts I use are TradingView. So I like to see my positions on the charts and trade directly through the chart. You can do all of that. And it's just really straightforward. So the link is in the description. Go there, open an account, try them out and let me know what you think. I run a WhatsApp group. I've been running it for about 2.5 years now. Twice a day, I take a look at interesting markets, a whole mix of markets, usually 4, 5, 6 plus markets I'm looking at. I talk about trades I'm doing. There's ongoing mentoring. There's a monthly webinar for people within the group. If you'd like to try it out, you've got to pay. But if you use the code YouTube, you get 25% off the first month, and it's only a month by month thing. So if you go to my website, again, the link is in the description down below, and use that code, you can try it out. And finally, there's a newsletter that I send out. I say every week, but I don't really send it out every week. Maybe every couple of weeks I send it out. That's free of charge. You can sign up for that below. And any questions, feel free to drop me an email. You know, I don't have all the answers, but I've been doing this a long time, and I'm not one of these many trading idiots on YouTube who tells you it's easy and all you need to do is A plus B plus C and you'll be making a fortune. You know, I've got a realistic view when it comes to trading. So any questions, feel free to get in touch. Right, back to it.
So the next element of that then is, you know, once we've decided how much risk we want to take on the trade, it's then, you know, almost sort of fitting the parameters of the trade around that amount. So this then comes down to position sizing. So as you just said, David, you know, if you do $1 a point, £1 a point on the NASDAQ, indices in the UK, you know, have 20-to-1 leverage. You know, so essentially, if you're sort of running that trade naked, your initial deposit, your initial margin is going to be, you know, a fairly decent size of a $1,000, $2,000 account.
Yeah.
So, you know, it's a simple sum really in your head. You know, if you know you're going to apportion, you know, 10% of your account, which is £100 to a trade, you know, then you need to be thinking about, right, what is the size of my trade? How many pounds per point? How many contracts am I trading on a CFD account? And then how far is my stop loss going to be?
Yeah.
If you're trading with a broker that offers guaranteed stop losses, of course, then you know that is the absolute maximum amount of risk which will be attached to the trade. If you're using non-guaranteed stop losses, regular stop losses, you know, then there may be slippage, but, you know, let's not get bogged down with that now. Let's just sort of think simply as to what size trade should I be doing versus the distance of my stop loss.
And there are plenty of brokers these days who let you trade really small. So going back to that example, let's say we were going to do a medium-term trade on the NASDAQ. We wanted a 500-point stop loss. I only want to risk losing £100 of my account. Then I need to trade basically 20p a point, isn't it? Or the equivalent in whatever currency you're trading. You know, and there are brokers out there. It didn't used to be that way 20 years ago, but there are brokers out there now, and we'll talk about one a bit later on, where you can trade that small. So you don't need to take on silly levels of risk. And I think, again, don't put the cart before the horse when trading. Don't be in a rush to start trading big if you're new to trading, you know, because the opportunities and the markets will still be there 6 months, a year down the line. So absolutely start small when it comes to trading. So we've talked about thinking about how much you risk per trade. We've talked about that position sizing. So if your stop is X away and you only want to risk £100 or whatever, or £1,000, you need to size the trade accordingly. And also don't put, again, the cart before the horse here. Don't think, I only want to risk losing £100. I'm going to trade £1 a point, therefore I'll have £100 stop loss, 100-point stop loss. That's the wrong way to do it, isn't it? Because you're basing your stop loss on how much you want to trade and your risk per trade, rather than the normal volatility of the market.
Yes.
So what do we need to bear in mind when it comes to how markets normally swing about, Will, during a day?
Well, the first thing is the actual typical daily range of the market that you're trading. Since we did our last video, we've obviously had the whole, tariff situation in the States, liberation.
I don't think we were responsible for that. Our videos didn't cause all that carnage.
I know some people have tried to blame us, but it definitely wasn't us. We were out that day. Essentially, even before and after, now that markets have, sort of settled down into their regular ranges, typically on an index, we trade a lot of indices, don't we? So we trade the DAX, we trade the Dow, we trade the S&P. You're now looking at a typical daily sort of high-low range of around 2%. And so again, we need to consider that, knowing the market that we're trading, because it could be, that even though we are placing a stop loss around 100 points away, actually relative to the market we're trading, that is still a very, very small percentage. So as part of, again, the learning curve, the learning process, particularly, for new starters, it's important to, get familiar with certain markets or certainly certain asset classes.
And just to go back to what you said about the range, I mean, we're recording this with 3.5 trading days into the week. And if I look at the NASDAQ, and clearly markets at the time of recording this, May 2025, markets are still a bit crazy after the whole tariff thing we've been through over the last 6 weeks. But just this week, the NASDAQ has gone from a low of 20,300 to yesterday 21,300. So we've seen 1,000 point range on the NASDAQ in 3.5 days. So it does go back to, we absolutely need to think about the volatility of these markets that we're trading. And if you think these markets are too volatile, that's completely fair. Either wait till they calm down, or like Will was saying there, look at trading something else. Perhaps trade, I mean, the European markets have had some big swings as well, but are perhaps a little bit less volatile than the US markets. Or look at individual shares. If you want some exposure to stock markets, but the indices are a bit crazy for you, have a look at some individual shares. Find a market that suits your own volatility profile. This is an odd time, and as the famous saying goes, this too will pass and we'll settle down to more normal markets. But you absolutely need to take into account the normal volatility at this moment in time of that market you're trading when it comes to stop losses. Okay, that's it for this video. There's another one coming probably in the next couple of weeks. So if you're new to the channel, welcome to the channel. Subscribe, like, all that sort of stuff. If there's any stuff you'd like to see covered in future videos, please feel free to leave a comment down below. I do read them all, even the occasional abusive one. So yeah, put that in there. You can drop me an email if you have any questions. Try out the broker. Don't forget, the link's down below. And also, if you want to get more involved and subscribe to the WhatsApp thing for a month, that link is down there as well. Use the code YouTube for 25% off the first month. So until the next time, don't blow up your account, and good luck with your trading.